What a year 2025 has been. Other than the infamous Liberation Day in April, we also saw multiple policy shifts and geopolitical tensions, and interest rates seem to be falling again. So as we look into 2026, Ray, what are some of the key macro themes and trends that our investors should be looking out for?
So let's start with where we were at the beginning of the year. Our core message to investors was that Asia would outperform and that they should be diversifying portfolios away from the United States. What's happened? China, Hong Kong, Japan, Korea, Taiwan have all outperformed very significantly in equities. Singapore's got the best performing bond market in the world, far outperforming US Treasuries. Cutting to the chase for this year, we think in 2026, Asia will probably outperform again. There are two core themes. The first is AI. This huge AI infrastructure build in the US is, if anything, just growing. That is ultimately a huge amount of Asian exports of semiconductors and other electronics into the US that will benefit North Asia. The second key theme is policy easing. The Fed's cutting rates, that's good for everybody. In Asia itself, we've had tax cuts and monetary policy easing in Indonesia and Thailand, in India that will feed into 2026. China's committed to about 5% GDP growth in 2026, and that's going to require a huge policy ease. So fiscal stimulus, monetary stimulus are all going to support markets in this region to a greater extent than the US.
Let's come to you, Vis. Given the macro backdrop that Ray has painted, in your view, how should our investors be positioned for 2026?
Investors need to think of Asia not as one big block, but as a series of different opportunities. We think you need to be active to be able to capture those opportunities, but the core hypothesis remains the same as we said a year ago. Global investors should consider diversifying their exposures away from much more concentrated portfolios. You're able to capture some of the AI dynamics from Asia as well.
It's good to see AI and policy measures supporting Asian markets going forward. I think it's also important for us to highlight some of the risks that we're seeing in markets.
I think there are two core things that really stand out for me. The first is quite simply valuations. The US market is at 23 times forward earnings. That's only 2 turns below the 2000 dot-com peak. It's above where we were at this time last year. So there's a huge amount of vulnerability there. Asian valuations have also gone up. We're no longer absolutely cheap, but we're not nearly as expensive as the US, and that provides a lot of defensiveness for portfolios. The second is really inflation in the US. I think the risk is inflation surprises to the upside, forcing the Fed potentially to have to turn hawkish. Well, that would be a major shock for valuations in the US, and it could generate a dollar rally, which is always a bad thing for EM.
What about you, Vis?
So I think that I go back to market concentration. It tends to make people complacent because the winners have been the same winners for a while, and we think it makes much more sense to manage that risk by taking a more diversified view of those themes that we think are long-term trends. Generally, emerging market investors have benefited when the dollar has exhibited some weakness. I think consensus is that we will see dollar weakness in the near term. There are risks that that scenario doesn't play out for various reasons. However, I think the change in the Fed chair will be the key moment of 2026. So our expectations would be that there is a fairly relaxed policy towards dollar weakness, but at the core of it, diversification clearly still remains a good thing to do if those are risks you're worrying about.
For more strategic insights and perspectives, please read our 2026 Market Outlook.